Now, and shares in Hong Kong fell this morning. That comes as investors waited for a key U.S. employment report after a host of weak data out of the world's top economy this week began to fan fears of a steeper global slowdown. Now, the index did manage to stay in positive territory for the week, helped by a strong market debut of Anheuser-Busch InBev's Asia-Pacific unit on Monday, and news of fresh government efforts to calm the month-long protests buoyed sentiment on Thursday. Now, the Hang Seng Index fell 0.5%. That sits at 25,969 points then for the Hang Seng as it went down today, while the Nikkei in Japan sat a little higher, 0.1%, doing a little bit better off on the day's trade. China still celebrating its Golden Week holiday, thus seeing that market remain closed. Headed off to the United States now, where Wall Street climbed last night after data showing services sector activity at a 3-year low fueled expectations that the Federal Reserve would cut interest rates in an effort to thwart a wider economic downturn. Now, the Dow Jones Industrial rose almost 0.5% to 26,201 points. The S&P 500 gained 0.8% to 2,910 points, while the Nasdaq Composite added over 1.1%, 7,872 points. Let's head on over now to the market picture out in Europe. Then, of course, a lot of what has happened here will certainly be based, yes, on Brexit, but also on quite a few factors out of the world number one economy. That economic look, of course, out of the United States will be quite key. Talks as well with regards to China and the United States, which kick off next week when it comes to that trade talk. And, of course, we've seen the United States decide to slap on tariffs on quite a few European goods as well. 10% on airplanes from Europe and 25% on other goods, including wines, cheeses, and even whiskies as well. What that means for the market? Well, a bit of a topsy-turvy time across the European market, with the German DAX going down today, the FTSE 100 and CAC 40 in France doing a little bit better. On the local front, though, we've had 2 terrible weeks, but today is slightly opposite in that front. The all-share going up just a touch there, just below that 54,000 point mark. Industrials doing a little bit better then, considering that Japan went a little bit better as well this morning. That certainly has infiltrated and filtered through to some of our industrial counters, seeing those head up, while the financials are doing a little bit better too. On the commodity share front, well, it's not such a good day, unfortunately. Those have headed down, 42,762 points for the resources. However, gold shares are headed a little bit higher, so perhaps some positivity coming through there. Let's not forget that we do have the junior mining indaba currently happening, but a whole host of CEOs really coming out and talking about collaborative efforts between mining companies would certainly help boost South African growth, and that they still have a relevant part to play when it comes to not just mining in South Africa, but also job creation and indeed growth as well. Overall then, let's take a look at the commodities. Well, gold now above that 1,500 mark. It has been languishing just below it, but it sits in and around it today particularly. Still not $900 a fine ounce and unable to maintain that one, of course. Demand seemingly not looking as well as it would have. $882 then for the platinum price. $58.03 a barrel. Yes, higher today, following what is a week of large losses then for the oil price overall. Onto the currency picture. Well, having languished at around 15.30, it is slightly better off still at 15.15, having closed just around 15.10 as well late yesterday. So slightly better off for the week, but still lower compared to yesterday. 18.69 for British pound. The euro sitting at 16 rand and 64 cents. So the market picture is certainly one we'll focus on. Let's try and call in Maudi Linzwano and perhaps get a bit of a chat here as well then about this market picture. Maudi, thank you so much for the time. Really appreciate it. It has been one where we've been oddly shocked then by getting new tariffs then input, and that on European goods. How much more turbulence does that create in this market picture?
Yeah, I mean, you're absolutely correct there, Arabile. Excuse me. We're in the fourth quarter, the final quarter of 2019, and you know, we've been languishing between negative and slightly in the positive. The last quarter was horrible, 5.8% in the rate. And I think, you know, you look at the fourth quarter, we certainly can expect further volatility into this sector. I mean, you still have a number of things, as you indicated in your opening. You have the Brexit, still the negotiations there are ongoing. You have the, you know, the trade war is still ongoing there. The negotiations between China and the US is going to resume. But I think that's just exactly what we've had the entire year of uncertainty, and uncertainty, of course, creates a volatility. And that's why you're seeing the only sector which is really in the green there is gold. gold will obviously perform better in these difficult times.
Yeah, as demand sort of grows then for that element. Do you think that we're sitting in a situation where we kind of don't know where we're going, so we're going to hover really when it comes to that market picture, because we're waiting for a whole lot of uncertain factors? Perhaps even November 2020 is when we wait to perhaps see off the trade war situation with China. If we bring on Europe, that certainly does hurt the market picture on the whole. All of those, including then the interest rate decision out of the United States, it's supposed to happen in October. A lot of that would be dependent on the U.S. jobs numbers, which do come out today.
And I mean, they're not looking good. I mean, we've moved from the time when the U.S. jobs were growing well over 200,000. And now we're sitting around, look, we're still strong, we're still growing. The last number in August was 130,000 jobs created there. The expectation is that we're going to see 135,000 jobs. But you're certainly seeing the U.S. economy, which is certainly showing some signs of weakening. You look at the ISM, the manufacturing data that came through, well below that 50 level mark. So the U.S. economy is showing some signs of cracking. And I think Donald Trump will come under a lot of pressure and a lot of criticism going into next year for re-election. I think he's bound to really look at it and say, if he doesn't do something to try and at least, find a way to resolve at least the trade issue with China, he is going to be compromised into the elections next year, because things will continue to decline. Things will continue to look weaker for as long as we've still got this trade tension and a lot of uncertainty added by the fact that you've got Brexit as well. October the 31st is D-Day. Are they going to extend it? Are they going to, go out?
I think they know what's bound to happen from there on. I think they have to sort out issues with their own Prime Minister, really, Boris Johnson, at this point in time. I want to just ask, does it really weaken Donald Trump? And I only ask this because that economy is almost at full employment, yet they still keep creating over 100,000 jobs per month, right? So surprisingly, there's clearly not full employment in that country. But he keeps asking for lower interest rates. They've gone down twice this year. They're sitting close to negative, essentially. How then do we carve a weakened picture of Donald Trump despite the trade war? How do we say then that his presidency has actually incurred weakness across the U.S. market?
Yeah, so look, I think what Donald Trump did was he benefited a great deal from, obviously I think what Obama had done. And I think when he came in, obviously granted, he did introduce a few things, which is the cutting of taxes. And I think the thing about, the tax, cuts is that their impact is immediate. There is a relief. There's pockets in the consumer's money. I mean, sorry, there's money in the consumer's pockets immediately. And that's why you are able to see some kind of resilient, if you like, on the economy. I think the U.S. economy has been driven by that, the fact that the consumer is strong and continues to, to really buy. And it does look like, it's stronger. But I think when you look deeper into the manufacturing sector, there's signs that because of they're not able to trade between Europe and China, the goods are not able to move freely. It is having that negative impact. And I think in the long run, you are going to see that. And those weaknesses are going to show, and it's perhaps going to be very late. And that's why he's insisting on interest rates cuts, because he knows, he can see those signs that if nothing is done by the 3rd, then the situation could actually get worse.
Should we be getting an interest rate cut locally? And what about the rand? Do you think stability there too?
Yeah, so look, I think locally I've always been advocating that we need to have a cut. We need to try and really work from the monetary side and the fiscal side. Both needs to play a role in ensuring that we get out of the situation that we find ourselves in. I think they missed in the last meeting by not cutting. Inflation is well, contained between that 3 to 6%. In fact, well around that midpoint. And when you look at the PPI, which is a leading indicator on CPI, it's also, has been slowing down for, I think, for the 5th consecutive month. So the inflation is well contained. What do? We need to boost, cut interest rates to try and boost this
growth picture, which certainly is languishing. Maudi, appreciate the time. Thank you so much for that. Maudi Linzwana is there from Lehumo Capital, joining us here, of course, in our studios in Auckland Park, giving us an update on that market picture. Well, after the break.